Hello, everyone. Nice to see you all. Thank you for joining. We are going to start in a couple of minutes. We're going to wait for everyone to join us. If you want to start writing down in the chat of this webinar, where are you from where are you watching us? We are happy to have you with us today. And we would love to know from where are you watching us. Thank you again for joining and thank you for your patience. We're not gonna take more than 2 minutes, but we want to wait for everyone to join us.
Looks like we got.
Wow, so we have people from Texas, Seattle.
It's good diversification. We'll get a lot of information from different markets. Try to tackle them all.
Thank you, everyone, for your patience and for joining. In about 2 minutes, we're going to start. So I started a poll to know more about you. From where are you joining us? How did you get to know us? So feel free to answer. It helps us a lot to improve ourselves. So we have Max Chera with us today talking about the hard money guide for real estate investors. So welcome to Real Estate IQ. This is a short presentation for people that maybe haven't heard about us. This is a QR code for you to join us and subscribe to our newsletter. So you can scan it. These are our social media accounts where you can follow us too. This is a very, very short video. So it's a very short introduction of what we do. So we are the #1 site to find the freshest and most accurate of market properties. Real Estate IQ is a lead generation, education, and a software company focused on helping real estate investors like you find deals within 90 days. Our off-market listings arrive daily in your inbox with the skip tracing included, and you can use them for wholesaling, house flipping, or renting. Our data-driven products are what you need to make informed decisions to start investing in Texas, Florida, Georgia, and Utah. So these are our locations. As I said before, we are in Texas, Florida, Georgia, and Utah. And these are the services that we provide: membership solutions, education, and coaching. You can get a free consultation, a personalized 30-minute one-on-one consultation to learn more about our products. And I don't want to steal more of your valuable time. Thank you, Max, for joining us today. And I hope everyone enjoys. Thank you for joining.
Thank you for having me. It's always a pleasure to be talking to the Real Estate IQ crowd. #1 is because you guys are active, hungry. I mean, anyone that's buying leads and attacking lists is probably getting somewhere, right? So handling your calls and just prospecting is the #1 way to get rid of all your frustration. So keep doing it, keep at it. Any questions that come up, I like to make my webinars interactive. I know they usually like to tell everybody to make, their questions and answers at the end. By all means, if anything comes up, any questions or anything that you're unsure of while I'm speaking, feel free to put it into the Q&A box. I'll make sure to be monitoring the Q&A in the chat box every so often. So if I see a good question, I will definitely bring it up. Otherwise, if I see that I'm going to answer it, I'll just wait till the end and make sure that you guys get your answers. But thank you again for everyone for being here tonight. Today, we're going to be talking about hard money. The goal of today's webinar is #1. I just want to make sure everyone understands this is not to be interpreted as any type of legal, tax, or accounting advice, anything like that. Please do speak to your attorneys, your CPAs, people that will work with you to help you understand the laws and make sure that you're working within them. Today's conversation is really supposed to be more about hard money, what it is, why people use hard money, how to use hard money, how does it work even, what are rate and terms typically look like, what should you as a borrower look like? The #1 thing, and I guess you guys could see all those questions, but the #1 thing I want you guys to keep in mind is, I know it's called hard money, but keep in mind it's probably the easiest money that you are going to actually be able to borrow when it comes to being in real estate. The reason it's called hard money is because it's based off of a hard asset, but don't let that trick you. It's actually one of the easiest types of financing to be able to acquire. So what is hard money? How did it come about? Pretty much in the crash of 2008 and 2009, lenders like us, private lenders, people in the venture capital space, they realized that there was a big gap in the market, right? There were lots of properties that were being purchased and flipped and being invested into, and there wasn't really a means to borrow money if you were somebody that found a good property. You had the right team to go ahead and execute the project. You had no ways of really going ahead and borrowing those funds. How would someone do that? Everyone was doing it with their own cash. So lenders pretty much woke up and realized, hey, we need to fill this void. And that's really where the start of our entire industry started. Now, what is a hard money lender? So a hard money loan is an asset-based financing, right? That means that it's based off the asset that you're acquiring. And it's typically used by real estate investors. We're talking short-term projects, fix and flips, burst strategies. Randomly, you'll see people that'll use it for wholesaling, anything where the whole time for the project is really short and you don't want to get into a long-term debt situation. Long-term debt situations usually come with prepayment penalties, a lot more requirements as far as being able to acquire that debt. So this is supposed to be a really simple and short version to get short-term money for your real estate projects. Okay. Now, why do people use hard money, right? So #1, it's a simple and easy process, right? So for their short-term deals, usually you don't need, or you're usually running against the clock. Your seller is selling it to you because they're getting a divorce, they're going bankrupt. There's usually a pain point involved as to why they're going about this. And that pain point requires you to come and solve that problem within a certain time frame, right? So there needs to be a simple and easy process for you to be able to work through in order to be able to help them acquire their property, get them the money that they need to move on with their life, so that you can now go ahead and take the project that you have on and start hitting your goals, which is to execute your project, meaning fix it up, get it into a good, stable condition, and move on from there, right? Another point of this is that it's also a numbers game, right? And that goes into why it's the manageability of it, and the simple and easy process plays a really strong part in that. What I mean by it's a numbers game is that it's anyone that's in the house flipping business, their goal is to acquire and flip as many houses as possible per year, right? It's a numbers game. The more offers I have out there, the more property contracts I'm going to get. The more contracts I get, the more successful flips I have. The more successful flips I have, the more money I make. So making sure that you have a process for each part of that and everything fits into it is a massive part of it as well, right? Sometimes the ability to borrow your money, it taking 2 to 3 weeks less time, could mean that you can now do more projects, and that one more project might save you whatever money you might have made just by getting, let's say, a agency debt. Agency debt is usually referred to as like Fannie or Freddie or anything like that, right? So where you're going to a bank and they're gonna check everything about the deal, right? You being able to do one more deal that year from that time and from the time you saved could mean the exact same difference in what you saved, right? Leverage. We're actually going to go into this at a high level later on, but I'd like to show you guys how leveraging will actually help you in the long run, right? So one person, I'll give you guys a little sneak peek to this, but if somebody has a project that they're doing and they're making one project and they're putting all of their own capital into it, and let's just say I, who have two projects where we're talking the exact same numbers. We're buying the property for 100K. We're putting in 50,000 for renovations. We're going to sell it for 250. Both scenarios end up exactly the same way. I borrowed money. He didn't. I did two projects. He did one. I probably made a nice chunk of change more than he did. And we'll show you how that plays out based on my cash on cash return, right? So leverage, use other people's money. And that's going to be the fastest way to grow your real estate portfolio or your business. Another good reason why people like to use hard money is because lenders understand the game, right? Most of us lenders that are in this space came from the real estate industry, came from the house flipping industry, and we all have experience to some extent to help you out, right? So that's something that you should be asking of your lender, right? What is your experience? What could you help me with, right? Because not just outside of the capital, there is so much more where you should be looking to your lender as far as resources, right? Hey, who do you know that I could reach out to about, expediting my permits or this and that, because I want to be able to finish my project faster, right? Being able to have a resource like that is another really big, valuable asset to have on your side, right? So these are just four of some of the many reasons there are to use hard money. Now, what are the top three reasons that borrowers use it for, let's say, for their investment properties? As we mentioned, timing is a really big thing, especially in the flip space, because you're usually dealing with motivated sellers. Motivated sellers do not have the luxury of time on their side. If they did, then they would be looking for top value and top dollar in the market, and you would not be that buyer for them, right? So obviously, most of these deals that you're getting are going to require you to move quickly, right? Hard money will allow you to do that. Approval criteria, right? Most properties that we fund when it comes to fix and flip, I shouldn't say most, a lot of them are usually also just little makeups and whatnot. But a lot of properties that we fund when it comes to fix and flips are going to be in a very bad condition where a bank will not even lend on it to begin with, because it's not in a livable condition. Maybe it's even adverse to the, it's bad for the people around in the community, right? So these are usually what you're going to find when it comes to these properties, and those don't go easy with the banks. So the approval criteria on its own. And then on top of that, also just you as the borrower, right? When it comes to working with the bank or other institutions, what they're going to require of you might be more than you can actually supply them with, right? So that's where hard money is going to be the simplest of the options. It's going to require the least of you as the borrower to perform. Flexibility, even the best plans can go AWOR. And that's kind of a big thing here, is the ability to be flexible, the ability to adapt to the conditions that we're in, right? So for example, your rehab budget goes up. For example, things are moving as time goes on with the deal, right? Maybe title has a little bit of a cloud that has to be handled. Hard money lenders usually have flexible terms, which what we call make sense terms, right? If it makes sense and it could get us from point A to point B safely and securely without giving extra risk to the lender or the borrower, it usually will go through, right? It makes sense. So that's where a big part of this happens. Whereas institutions, what says in the loan docs or what it says in our agreement is what we hold by, and that's that. So just that ability to have that conversation, communicate with, and say, okay, well, does this make sense for us to go this route, is another big reason why investors like hard money loans, right? And that becomes a thing of just relationships as a whole, right? Being able to communicate with the person that you're dealing with is really big, and knowing that, hey, this is the person that's funding my deal. It's not coming from, this big LLC, who's then, I'm talking to the rep of the manager of a rep of a rep. You're actually talking to people that matter and can make these decisions when you're working with hard money lenders. So how does it actually work, right? How does this all break down for us? And now let's get into that. So what is the responsibilities of the hard money lender, right? What are we supposed to be doing for you? We're supposed to underwrite your loan, right? And service, which breaks down into the following, right? So we need to screen the borrowers. And what that means is we need to feel comfortable with the borrower's ability to perform on the project, right? Not every project is the same. Not every borrower has the same strengths as each other, right? Understanding, hey, borrower A is a contractor who's going to get cheaper cost of material and cheaper cost of labor. That's going to play a big part, right? Or you have another borrower who's like, hey, I am so financially responsible, and on top of that, I'm also a realtor and I have the ability to see what comps look like. I know where I can save myself money on the sale of my property, the purchase of my property, right? All of that does play a big effect in how we see the deal. Sometimes it's just, hey, I've done this many times and time over, and I'm considered a successful investor, and that's what we're going to trust on its own. But again, we work with new investors, we work with experienced investors, and this is a big part of us helping the borrower, right? We don't want the borrower to take on more than they can chew, but we also want to make sure that we're giving them enough room to grow and take on a little bit of risk, in the right places so that they can accomplish their goals. Evaluating the properties, right? That's actually one of the bigger things that we've seen, or where at least a lot of borrowers will struggle, is the ability to produce comps, a nice CMA. It really depends on the location of where you are. I noticed that we had actually earlier we mentioned how there were people from all over the country on our webinar tonight. So that means that we have people from Texas, New Jersey, Atlanta, I remember. And keep in mind that you're going to see certain markets. So for the Texas people, I'm going to refer to, let's say, like the Austin outside markets, the Pflugervilles, the Round Rocks, Leanders, where they're kind of making the properties cookie cutter, right? Everything looks exactly the same as each other. Those are the easiest places to produce comps, right? It's very simple. The 1,800 square foot model of floor plan A gets 180, and that's that. Oh, but you're on a little bit of a better place because you're a little bit higher, so you have a better view. Okay, we'll give you 190, like that's simple. But where it starts to get complex and complicated is when you start to get into maybe some of the the more luxury neighborhoods, where now you're starting to see, hey, these properties are not the same, or maybe they are the same or started the same, but now each of these people started to develop it differently and create their own little home for themselves. In New Jersey, we actually get this a lot, or even New York, right? There's a lot of brick homes where they were built the same, but then you start to enter newer territories or neighborhoods where they've remodeled them, and things can start to change. So I guess what I'm trying to say from all this is that comps can be sometimes daunting. Sometimes it can be very easy. Make sure to, if you don't have that skill set, right? Maybe you're not a realtor. Maybe you've never done real estate before. Maybe you're not a wholesaler even, and you want to learn how to properly do comps. There are softwares out there that'll help you with this. I don't like to rely on those either. I like to use those as a starting point to make sure that I'm on the right page before, let's say, I would bring in my third party who would help me, where I'm going to ask them to do some work for me. But partner up with a good realtor, right? Build a team where you'll be able to go to somebody and say, okay, well, what should this value at if I were to make it just like the rest of the homes in the neighborhood? Find something that you're actually going to target it to look like, right? I don't want to, my goal is not to make the most extravagant home in the whole neighborhood. My goal is to make the same home that most people are comfortable living in this neighborhood, so that I can cater to that community. Someone that is a millionaire does not want to live amongst people that are not millionaires. Someone that's a billionaire does not want to live amongst millionaires, right? They want to live amongst themselves. They want to feel that same territory, that same community, if you want to call it, right? Just think about this. If you spent a lot of time, mowing your lawn and taking real good care of it, and then your neighbor just fell over, it was always dry and things like that, you'd feel a little bit bad that yours is sitting right next to it, right? So think of properties that same way. don't put something where it's going to get devalued by what's around it, and don't put, and quite the opposite also, right? Don't devalue the other neighboring properties by not doing enough to it, because that's when you're going to sell yourself short. But yeah, we went a little bit of a tangent there. Evaluating properties, helping you guys understand, hey, look, we looked at the market, this makes sense, or we see a result where this could be worth that, right? We'll obviously always go through with an appraisal where they'll be able to tell us based off the scope of work that you've put together, what that property could value at. But again, we're always going to kind of take a look at it prior to and kind of give you our opinions on it and see if what you're saying makes sense and if it actually pans out okay. Another thing that we were responsible for is dispersing the funds. And this is actually a really big topic that you should be, or conversation, I should say, that you should be having with your lender, whoever you decide to use. And the reason is that everyone has a little bit of a different disbursement process, right? With us at Express Capital, the way we go about it is that we have two options, right? You could either log on to our app, take photos of the work that was completed, submit it through that same app, and it comes right back to us where we're able to verify and say, okay, this work was completed, and now we're going ahead and dispersing the funds. Or you can elect to say, hey, I'm a hands-off investor. I don't really show up to my projects. Why don't you send somebody out there for me? And we can send out an inspector who will put together a full report and give us more and kind of tell us exactly what was completed and what was not completed. And that's a really big thing, by the way. A lot of people see this as like, oh, it's part of the process that I have to learn. Yes, absolutely it is. But don't let that scare you. This is actually there to protect you, right? And why do we say it's there to protect you? One of the biggest reasons that a lot of fix and flippers don't succeed or go through a project that takes a loss is because they have a bad contractor, right? The contractor, maybe they paid them too much and then they left the job and didn't complete the work for them. It happens all the time, right? So our goal is to make sure, hey, we're not letting your money go until we're not dispersing these funds until they've completed the work. And the more you follow through with the way that we operate, the more successful you're going to be and the more protected you're going to be. So utilize that as a way to say, hey, Mr. Contractor, here's guaranteed money coming from my bank. You need to now just tell me when you're done and I'll pay you, right? That's the best way to go about it. Obviously, yes, you need to get them supplies or a small balance in the beginning to get started, which is normal. But again, keeping them accountable to only paying them for what's done and not paying them in full until everything is done is going to be a big game changer in all of your businesses if you're not doing it already. And additionally, we go ahead and service the loan. We make sure that the monthly payments are coming in. As Lonnie had a quick question, how many days from uploading the pictures do you get the funds? That's a really good question. And the answer to that is 24 hours. So once we have either our report that gets done by the inspector, which will take probably an extra day, or once we get the pictures from the app, we will then fund the deal within the work within 24 hours. Great question. Thank you for asking that one, by the way. So where is capital deployed? So we put it all into either the purchase and the rehab of properties. Draws are the cash to complete the renovations, as we mentioned. And then we have interest only payments as far as what you guys are paying every month. The reason that we do interest only and not PITI or anything like that is our goal is to keep your overhead low while you're in the project, right? We're banking on you being able to complete this project and getting the principal afterwards, right? So we're putting our money where our mouth is and saying, hey guys, let's go. Here's a low payment, go make it happen. You'll pay us the full principal balance once you're ready to sell. And that also goes into effect to say, by the way, that there's no prepayment penalties, right? So the faster you sell your property or the faster you complete your project, the more money you make, right? So again, some of the best investors are doing their deal in 3 to 6 months as opposed to 6 to 12 months, right? That's the key to make it to, and you're only paying the interest payments that you've had for the months that you've held the loan, right? So if I've only done 3 months worth of payments and then I sell my property, that's all I have to pay. I don't pay anything more. There's no extra interest payments that I have to make to make up for a minimum or anything like that, right? So, and make sure, by the way, that all of your lenders that you work with have something similar, because that should be a standard in today's market. Eric wants to know how long the loan is for, and that's a great question. When it comes to hard money loans, there's definitely a wide range that you'll see. For example, in the residential space, most of them are going to be for 12 months. Now, I've seen many lenders, what do? They'll try to advertise their product as a lower rate. So for example, they'll say, oh, we're offering a 9% interest rate, but their loan is for 9 months. Whereas let's just say I put that same product out for 12% for 12 months, you're actually paying the exact same amount every single month to both of us. One of us is just giving you a shorter time frame to accomplish it in, and one of them is giving you a longer time frame to accomplish it in, right? So really what you need to do is interest rate divided by the amount of months that you have, and that should give you the perfect example to say, okay, I'm paying X percentage a month. In this case that we just said, it was 1% a month for 12 months, 12%, right? So use that same math whenever you're trying to figure out and see which is cheaper, especially if they're giving you different terms. Now, there are also commercial deals and things like that, or bigger projects where you might need more time, right? Yes. So now then you'll see 18 months, you'll see 24 months. Those definitely do show up more often in the multifamily and commercial space. But even then, when you're doing that, you generally don't want to go that long. Your goal is to get out of this as soon as possible. We're getting a lot of other really good questions that I'm going to answer soon, so I'm going to get back to those shortly, but keep your questions coming. If it's something that I'm in the middle of, I'm going to stop and answer it. So now we mentioned that we want to keep interest payments low to keep things flowing. Let's go to the next one. So now, as far as LTVs and things like that are concerned, like how do hard money lenders look at this? What do we consider? And this is actually probably the meat of the entire presentation. So by all means, any questions, keep them coming in this part particularly. So in today's market, let's just say, and this is a little bit skewed. I know there's different products out there, but there's, home buyers usually are putting down between 3.5%, 10%, 20%, depending on the type of mortgage that they're taking out. But for the purpose of this conversation, we're going to use a 10% number that they're putting down in the house, right? So for an example, most people understand loan to value to mean that if I'm buying a home for $100,000, I need to bring $10,000 as down payment if I'm putting down 10%, right? And now when it comes to hard money lenders, things are actually a little bit different here, right? Or not different, but we take in different numbers into consideration, right? So the first thing that we're taking into consideration is the purchase price, just the same way your average lender would do. We're then also taking the rehab budget. And then on top of that, we're also taking the after repair value. So as a hard money lender, we take the after repair loan to value, right? Because loan to value, very simply put, right, it says it in its name, is the loan amount to the value, right? The percentage of the loan to the value. Now, value, just like anything else, is a very, it depends on how you're referring to, right? Are we talking about the current value, the future value, the middle value, right? How do we want to look at this? So we want to take the after repair value. We want to take the current purchase price to be able to determine, and there's one more key term in there, by the way, that I just added in. This is the first time I added to the presentation. It might be a little bit more advanced, but I'll use it anyways and kind of try to show it to you guys. It's loan to cost, right? So the percentage of the loan amount versus the cost of the entire project. So that means that the purchase plus the renovation and my loan amount compared to it. We're going to explain that right now, okay? So the three numbers that we need is the purchase price, the rehab budget, and the ARV. Everything else is then going to come from the lender or is self-derived based on the numbers that we know. So in this example, yes, this is probably one of the better ends of the spectrum where you're getting 90% LTV on the purchase and 100% of the renovation cost. I want to use this example to help us understand what these loan to values are, how they play an effect here, and how we're viewing them, right? These are some numbers that most of you have never really looked at. This is what we look at all the time when making our calculations or determining if a deal is a deal. So let's start first. The purchase price is $100,000. we're giving 90% loan to value on the $100,000, which means that your initial loan amount is going to be $90,000. Very simply put, same as the previous example. Now we also have a rehab budget of $25,000, right? So now my total loan amount is the 90 plus the 25, which brings me to 115. My after repair value, I'm sorry, guys, that was supposed to say 200,000, not 100,000. Obviously, that would be a terrible deal. But just imagine you see a 2 there. Imagine so we have an ARV of $200,000. So now my loan amount of 115,000 divided by 200,000 is going to give me 57.5%, right? Now, most lenders want you to be at 65% or below. So that's a good threshold to use. Especially for today's market. Let's say in the previous markets, people were using 70 and 75%. I like to say 65 to 70 was always where it was, and that's where it should be in a healthy market, and try to keep it, you know, obviously the lower, the more profitable you're going to be. Now, the loan to cost perspective, right? What does that mean? So now if we take the 115, which is our total loan amount, and we divide that by the 125 that it's going to cost me to do this project, I am now borrowing, it's very simply put, I'm borrowing 92% of the entire cost of this project. Now, why is that important? In all honesty, a lot of lenders are actually going to cap that to 90%. We are true 90% LTV lenders, so that means that when we do say 90%, we will go up and above that to the 92s, the 93s even. Again, we don't want to stress that too far out. There are exceptions to the rule, and that's usually when they're what's called lopsided deals, which means that your renovation budget is costing more than your purchase price, or maybe it's just a really, really high percentage of that, right? Those are really massive rehabs, takes a lot of experience to be able to navigate through those renovations and make sure that your team is operating properly on it and hitting timelines, right? So in those scenarios, let's say, yes, there might be scenarios where you're capped to 90% cost of the entire project. So if anyone has any questions on that, I'm going to give it a couple seconds so that you could type them up. I'm going to go into the next part a little bit while I give you guys that moment. But this is a really good basis to help you understand what that conversation will sound like, how it's going to be presented to you, what your term sheet's going to look like, right? So, for example, one thing that could change terms is, let's say your ARV comes in at that 100,000 where it's listed at right now, right? So you bought it for 100, you put in 25, but the appraiser says, yeah, based off of this, you're only going to get $100,000 for the property. Well, now your AR LTV percentage went up, I'm sorry, to 115% or whatever that number is, right? What happens there is now the lender's gonna have to say, hey, by the way, there's no more room on this deal for us to give you the same offer that we had. First off, in that scenario, that whole deal would probably be dead because of the size of because you're buying it for its worth and putting in extra money, but whatever, there's other ways of going about that. But what I'm trying to bring out here is now you know what your buffer is, right? Hey, what's my max after repair loan to value that I could hit? Now you're asking the right questions. Hey, what's my max loan to value on the purchase that I can get? Oh, so is that why you're capping me on the initial loan amount because of the after repair value percentage? Yes. Okay, now I understand, right? So that's how this is all comes about. It looks like we got to get some questions. What is the cap on the LTV that you would lend to? So we do cap at 75. That's our highest percentage that we would ever lend out when it comes to after repair values. But again, it would depend on the project. It would range between 65, 70, 75 is really where things kind of work themselves out. And that kind of depends on the borrower's experience, the project, and the deal as a whole. Back to what we were up to. So again, understand these percentages, how they work. Now, just for what I was telling you guys earlier, leverage and how important it is, I actually would like to bring up another sheet real quickly. Give me 1 second. I think this is going to be a really valuable exercise where making this as we go though, so work with me. I'm going to get this up as quickly as possible, but I think this is really going to help a lot of you on here. And since we have so many people with us tonight, I felt like making this a little bit extra special and giving you guys as much information as I possibly can. So I appreciate all of you for being here and for investing in yourself with your time. Okay, it's opening up right now. Okay, so let me just share my screen. Okay, so you guys can see my Excel sheet now, I assume. If you guys cannot, just put it in the chat box and let me know so that I can correct it. But let's take our example. So we bought a property for $100,000. Our after repair value we said was $200,000, and my renovation budget was $25,000, right? And we said that I qualified for 90% of the purchase, 100% of the renovation funds. We'll just keep things simple and just say things are at 12 and 2 just for argument's sake. And now what I want to show you guys from here is how leverage actually impacts the deal. And by the way, I know that I'm using a spreadsheet that might look a little bit fancy or just, with a lot of functions. You actually, and I'm going to go into this with you guys a little bit later, you're going to have full access to on our website to do these calculations by yourself and print out a full report on your deal. So just stand by with me. I use this because it's just faster for me to operate through. Okay. So in this same scenario, this borrower made $37,000 and it costed them, call it $23,000 to close, to do the project. And that includes having money set aside for the contractor, right? 10% of the renovation budget is what I usually count for, as you'll see right here. So it accounts for the down payment, $2,500 for the contractor to set aside, let's say first month's payment. And then you have all the closing costs, and this is third party and everybody involved. Let's just say you needed $23,545 to close. And now let's just say, even in the same example, it takes us 12 months to do the project, which on a $25K budget, I don't think it would take anywhere close to that, but we're going to assume for the worst. This borrower has spent, with his $16,000 in interest and origination points, and let's say you want to even include taxes and things like that, we're at what do we say, 23, 33, 39, call it $42,000, right? On that $42,000, he made $37,505, right? He made, and it's not really 42,000. That's why you're seeing 105%. But let's just use what we have in front of us. He made, or even call it 100%. He made 100% on his money, which means that for every dollar he invested, he made $1 back. Now, let's say that a different investor found that exact same deal and said, you know what? I don't want to spend money on the origination and the interest and things like that. I don't want to do that. I just want to make the most money I can by using all of my own money. Well, what happens is this borrower now needs $133,000 to complete this project. But yes, he did make slightly more dollars, right? He made $54,000 as opposed to my 38, I think it was, right? So he did make close to $20,000 more than I did. But what's the difference is that he spent $133,000 to do that. I spent 40. If I take my 40 and I use it twice, right? So now I spent 80. I still spent way less money than he did, or invested way less money than he did. And guess how much money I made? I made $80,000 on those two projects, whereas he only made $54,000. So that is a big part of of finance and how it makes sense to leverage yourself and why people use it, right? I really felt that this was a big piece. If anyone has questions on this, I'm going to be on standby for another second or two before I go back to the presentation. So Lisa Young is asking, what is the math to get the loan to cost? Great question. Let's go over that one more time. So let's just plug this in real quick. So what we're doing right now is we're looking at the cost of the project, which is $100,000 for the purchase of the property. And then we're looking at the renovation budget being $25,000, right? So my total project cost is $125,000. Now my loan amount is 115%, is 115,000. So if you do 125 divided by 115, am I doing that backwards? 115 divided by 125, actually, I'm sorry. You're going to get 92%. So that's how you would go about getting the loan to cost, right? It's the percentage of it's the loan in comparison to the cost of the entire project. For Mr. EC, I do believe that this is recorded and we will have it available for you guys later. I know there's a lot of information here. Well, for those of you that have been with me the entire time. So if you guys want to hear this again, by all means, that will be available. But now let's go back to where we were up to. Okay, so I think we all got a good idea now on how LTV works, loan to cost, things of that nature, how these numbers project themselves, and also what questions you might now look to ask to your lender that you choose to work with based on this information, right? Hey, what's my max? If they give you a term sheet which says, oh, I'll give you 90%, but your after repair value has to be 60% or below, and right now it's 57, so it worked, but that value comes in slightly less, and now it goes to 63%. Well, how's that going to affect your loan when it comes to underwriting, right? That's going to change, and they're going to change that on you, right? Even the best lenders have to change terms when numbers change on them because, hey, things just don't add up here or not making sense. So how is that going to impact your deal? And just having that knowledge is going to help you drastically being able to come up with solutions before they even happen. So, and then we answered the cash on cash already and the profitability. So I think it's safe to say we can go to the next slide. Borrowing rates. Okay, so I got a bunch of these questions already in the chat. So I think this is going to be a good conversation, which is loan rates and terms. How long are our notes? Our notes are short term. I think we spoke about this already even a little bit. So they're temporary financing. They're usually going to be 12 to 24 months. Again, some of the bigger projects, commercial, you'll see 24, 36, but in most residential spaces, 1 to 4 units, you're going to see 12 months as probably your number one or main number. By the way, as the lender, also want you to be in and out of that deal quickly, because that allows us to also leverage our funds over and over again, right? So we're both incentivized to have this deal done as quickly as possible. So we take that incentive and put it back to you and say, hey, the faster you get this deal done, the less you have to pay in interest. Interest rates, they definitely vary significantly, especially in today's market. I can't think of a market where they fluctuated this much before. It does depend on location, risk, the borrower, who's doing the deal, and things like of that nature. What I would say is right now, our rates are going to be anywhere between 10.5% and 12%. That pretty much does fit into the rest of the market. Keep in mind, are there places, when it comes to anything you're buying, whether you're buying a car, whether you're buying a house, what you get is what you pay for, right? And the reason I say that is because it works very similarly in finance. There's always going to be someone that's bark a cheaper rate or something like that in your ear, but does it mean that that's the right thing for you? Maybe it does, right? I'm not going to be the one to say that it never is. Maybe it is. Maybe that is, you're sophisticated enough where you can manage everything on your own and you don't need assistance or things like that. And, you could afford to get a lot of services pulled out. Sure, no problem. Most people, however, that's not the case. Most people will usually strive and do better when they get more services, more support, ability to communicate with somebody, right? So and the reason I say this is because there are lenders out there where they remove a lot of their overhead and they will give something a little bit cheaper. But what does that mean to you? What does that mean to your process? What if they did give you a cheaper rate, but it also took them an extra 2 weeks to get you your draw? How would that impact your deal now that they're forcing you to stay in the deal longer because you need that, right? So look at things from a very broad perspective. Try to understand the full picture. And I think that will help you guys really choose the best person to partner with when it comes to your deals. And again, think of your lender as your partner, because there is nobody in your deal as long as your lender. You're a realtor. As soon as you sell the property, they got their commission check, they're happy. And guess what? You're going to come back to them, whether you made money, whether you lost money, they're going to help you sell that property. They're going to be happy, right? Your title company, very similar. They're happy. They got paid once it closes. Everyone's good. Your lender is the only person that stays in the deal with you throughout the entire project. And even though, yes, you're paying interest payments, we did not make a profit until we got paid back our actual principal of the loan. And we're there to ensure that you get paid back that you make that principal back, right? As best as humanly possible. So, and again, for Mr. Amisor, who's saying that the interest in that example would be 14,000, that's a lot. Yeah, well, I would agree with you, but what would you say is for somebody who spent double or triple the amount of money that I did and made less money with it? I would still rather any day, I will pay you for a service that is going to make my process, my business, my profits greater, right? So keep that in mind. You know, look, what you get is what you pay for at the end of the day. Anyone who looks to cut corners usually gets cut themselves. And that's what we're here to help you guys avoid. So yes, interest rates were definitely a variable this year. They've gone up, they've gone down, they're stabilized now. We do expect them to come back in the next year or so. But again, any other questions on that, feel free to let me know. Origination points, these are a percentage that are paid up front. So for Ro, who just asked this question, actually, these are paid up front at the time of closing. And these are to originate your loan, right? So that's to get your loan officer. And again, when I mentioned before, also partner with your lender, know who your loan officer is, know who their management is. That's going to play a big part in this because you want to have a good relationship with both of them. Your loan officer is going to help you drastically in structuring your deals. You're going to bring something to the table and you're going to be like, hey, this is what I got. How do I make sense of it? You might have thrown out a deal where he was able to put it together for you just because of the structure or the way that he was able to move money around. Have those conversations and look at them as your partner. They're there to help you. We want to make sure that your deal gets funded because that's how we get paid. And at the same time, we also want you to be profitable and we want you to get your money back because now we can do more business with you, right? This is all a relationship. If I get you into one deal and you disappear off me because you didn't make money off of it, none of us won, right? Our goal is to make sure that you're profitable, you're building a business out of this, and it's going to be consistent for you. So as I mentioned before, guys, remember I was telling you about the deal calculator where you'll be able to use something of that spreadsheet that I provided for you. Well, here is the link actually to our deal calculator, which we have on our website, which everyone will have free access to. I'm going to make sure that I do this to everybody. I'm going to put it in the chat. Host and panelist. I want to send it to everybody. Maybe Maria will help me with that later because I'm not seeing the option to send it to the entire group for some reason. But anyone who wants it, it's deal calculator. It's on our website. If you just go to expresscapitalfinancing.com, on the top right corner, you'll see resources and then deal calculator. We have a fix and flip one, and we have a DSCR calculator. So what I would say is get pre-approved. Thank you, Maria, for that. That was greatly appreciated. Have a conversation with your loan officer, get pre-approved, know what to expect as far as rates, points, all those things, so you could plug them into the calculator and have a very educated conversation or be able to put educated offers out there, right? You want to make sure that whatever offers you're placing, you're going to be profitable for. Well, this is a really good way to start, right? Being able to just come up with your own little P&L. So by all means, this is a free tool that we put out there for everybody, for all of our friends and families that want to invest in real estate. So now, I know we probably covered this as a broad spectrum, but I think it would be good to actually, and I've been getting this question, Kennedy and a few other people put it in the chat box even. What do we look for when we're funding, right? The way most of you guys asked it was mostly in the sense of experience, credit, things of that nature. But right, Max, what do we actually consider? What are we looking at when we're considering these deals? So we're looking at the collateral, right? What's the property? Where is the property? Where is the property? Is it in a very rural and outside of the main city? Is it directly in a very urban, in a dense populated area? Is it a high volume area where properties sell pretty consistently, or is it a place where properties sell once every couple of years? That's what we're looking at, right? What's the collateral look like? And usually that comes in the form of the appraisal report, by the way. Usually the appraisal is going to say all that information, and that's what we're looking at. Condition of the property, right? What does it look like now? And what does it have to look like when it's ready to be sold? Capacity is more on the borrower, right? What's the borrower's capacity to get this accomplished? Has he done this before where we should assume that it's, hey, 10 times later, if he's done it 10 times, he's going to do it again? Sure, that's one way of looking at it. Sometimes it's, hey, he's never done this before, but he has certain licenses, or maybe where he comes from would allow him to be able to execute on this. Well, great. That's another way that we could look at it, right? So what's the borrower's capacity to actually get this deal closed? Capital, how much money do we have to put down, right? As hard money lenders, yes, we do offer high leverage, but we still base that off of the borrower having skin in the game, right? A lot of our comfort level comes from saying, oh, well, the borrower has X amount of dollars in the deal. So that means that if he has that much, we're probably okay with it, because they're not going to want to, just let that go, right? They're going to care about their money the same way we do. Character. Really what I would say about character is, how you treat people, how you go about your work ethic and business ethic is a big part of things. I will say that there were definitely scenarios where we've had deals ready to go, and unfortunately we've, let's say, been mistreated in a very disrespectful way, where it might feel like, oh, that person's character is not good enough. Let's maybe not do. Think about it yourself, right? Who would you go into business with? If someone approached you and said, a random person said, I want to go into business with you, how would you judge their character, right? If they have their voicemail, every time you call them, it says, hey, if you're a debt collector, hang up now, whatever it is. Yeah, you're not going to want to hear that, right? So be a normal person really is where it comes from. I wouldn't say there's things that you should do to have good character. It's more things that you shouldn't do. And I think most of you know what that is. Credit. That was a big question that was been bouncing around in the chats, I know for a fact. So correction part. Okay, I'll get back to that one soon. But as far as credit, really, we're not sensitive to credit, right? We can structure things in a way where we can actually work through credit. I've seen people where they're really, really good at, construction and things like that, but maybe they're just not the best with their finances. Maybe they have a 550, but they've done this so many times. What we'll do is, let's say, we'll say, hey, look, we're going to fund this deal for you, and we're going to give you the high leverage that you qualify for based off of your experience, but we're going to hold, 3, 6, 9, or 12 months, depending on how bad the situation is, of payments into an escrow account. If you sell the property early, that money's all yours. It's just being held there so that we can manage it and make those payments for you, right? So there's different ways to mitigate this. We've actually had people where they would partner up with people. Hey, I'm the experience. You're the credit partner. Together we make, a really good profile. Great. Yeah, that's one way to get about it too. But yeah, the only time really that I would say that we wouldn't be a good fit for somebody with bad credit is if they're, like, say, brand new in the business, very low, they don't have a lot to put down on the deal or something like that. Yeah, that could be something where, let's say, credits in the 500, low 500s, and they don't even have down payment. Yes, that could be problematic, but generally speaking, we would normally be able to maneuver through that or work through credit issues. And then before we get the last slide, before we get into questions and answers, which is the hard money application, what does that look like? Most of the time, I would say 90% of the time, I'm taking down my applications over the phone. Actually, it's always best for us to be able to communicate and hear each other and understand what you're saying about the property, what your vision is, how you see it going about. But what we're going to ask you to send us is personal identification, which is usually just your ID, the purchase agreement, right? So that we have the contract, the renovation budget, or also known as the scope of work. It would be best if you include the contractor's quotes, because that shows us, that you're coming up with quotes that are legitimate. And obviously you want that also, because the last thing you want to do is get a deal funded and then find out that the amount that you thought it was is less or more than what it was going to be. And now you don't have enough money to, complete your deal, and now you're stuck, right? So you should always get the quotes first from your contractor. Best to actually include it, or a lot of people actually will use the quotes as their scope of work, by the way, and that's perfectly fine. Contractors, especially ones that do deal with fix and flips a lot, will understand that and know that. And then the last thing is a BPO or a CMA. Comps is, in short, really showing where you're finding your value. This way you can make our job a little bit simpler when we're looking at the market to see, okay, does that make sense for this property? Do we see this property selling for that much? And the reason that we look at that, really, realistically speaking, I don't have to, right? Because why? We're going to get an appraisal. But we care about your money. We don't want you to spend money on appraisals if we can see something right away that doesn't make sense or we catch it, right? So a good loan officer is going to review your comps and is going to ask you for them to make sure that your deal is sound, right? The same way as a doctor, right? The last thing you want to do is that you walk into a doctor's office and says, oh, you need heart surgery. Whoa, what happened? We didn't check me out yet, right? Well, that's what we want to do. Let's check you out. Let's see, does this hurt? Does that hurt? How does this feel? And then we'll be able to diagnose you properly and say, okay, this is a good deal. Let's move it forward. Now it's worth spending the $500 to $800, let's say, on the appraisal and moving this forward. But that's pretty much the simple version of how the application works. Once we actually get to once we've gotten past this and now we've issued you a term sheet, we'll ask you for some additional documentation, such as your entity documents, right? We only lend to entities, whether it's an LLC, corporation, it doesn't matter. And then we'll ask you for a personal financial statement, which is pretty much to complete the profile. It's just to have one on file for you. We'll get a credit authorization, and we'll get your track record, right? Those are the main docs that we'll need. If there's, weird deal and there's something extra that's required, you'll know about that right away. But otherwise, that is the gist of it. So if anyone has any questions that I did not cover on this presentation, please do feel free to flood the chats, the Q&As. I'm going to be searching through them right now to find some good questions. I want to see if I could find just a slide. Here we go. So here is my contact information for anyone that wants to reach out. My name is Max Chera. I'm one of the managing partners at Express Capital Financing. What I do is I handle the sales, marketing, and really education platforms that we have at Express Capital. So if anyone wants to reach out, has questions, feel free. You have my direct line here and my cell phone number as well. The best thing to do, by the way, for the fastest response, if you have a deal that you're looking to get to work on, would be to email us at info@expresscapitalfinancing.com, which I'm putting in the chat right now. Hopefully Maria would be kind enough to put that one to everyone as well for me. That would be the best way to contact us and make sure that you're getting a quick response, especially if it's about a deal. Definitely do send it there, and we'll make sure to get you a qualified loan officer that could handle your deal and assist you. All right, let's get to the Q&A now. So let's go to first to the Q&A because there's less in there. So Anonymous is asking, do we do HELOCs? And this was a conversation, I saw this question a couple of times. I think I skipped it because I wasn't really part of what we were talking about. And not necessarily in those words, we don't do HELOCs, right? A HELOC is a home equity line of credit, for those who are unaware, which means that it has to be on your home, right? So because we're not lending on your homes and we're lending on investment properties, what we do is we do offer cash out refinances and 30-year debt options, which are for cash flow properties and things of that nature. Now you can also cash out of a property in order to, very similar to a HELOC. The only difference would be is that a HELOC comes in the form of a line of credit where you only pay as you pull out, whereas, and I'm going to bring something back on that. Whereas our products are just a straight cash out. We're going to go ahead and wire you over the full amount of the money. And now you go ahead and use that and invest that money, or use it for whatever you had planned for it, right? But speaking about paying as you go or as you need to, keep in mind, right, one more thing at Express Capital Financing, you only pay interest on the funds that you've taken out. What I mean by that is, on the scenario, let's say that we're talking about before, I borrowed $90,000 for the purchase, $25K for the renovation cost. I'm only paying day one interest on the $90,000. Tomorrow I pull out 10K of my budget. Now I'm paying interest on $100,000. And then 2 months later, I pull out the other 10,000. Now I'm paying on 110,000. And then finally I pull out the 5. Now I pay money on that, right? So it's as you go, is as you start to accrue the payments there. Fatima wants to know about buying and holding. So yes, same answer for you. We do have a 30-year product on our website. It's called Rental 360. That's for your 1 to 4 unit residential properties that are cash flow positive, or you're purchasing them to be cash flow positive. We definitely have a product for that. A lot of people will actually use that in complement to our fix and flip, right? So they'll use the fix and flip loan first to get a property undervalued and do work to it to put in sweat equity, and then they'll go ahead and refinance it with the 30-year product so they can hold it, pull out their down payment, and then re-go into the next deal, right? That's called the BRRRR strategy: buy, renovate, rehab, buy, rehab, renovate, rent, refinance, repeat. Sorry about that. Anonymous wants to know property ARV is 300K for, okay, so you can send us that information to info at Express Capital Financing, and we'll make sure to get you a quote. Just let us know what you're looking to do, and we'll make sure to help you out as best as possible. We do lend. Another question coming up is, what states do we lend in? We lend in pretty much 47 states. The only ones that we do not lend in are the 2 Dakotas and West Virginia. We're actually have done a couple of deals in Alaska, even type of thing. I think we got one submitted in North Pole, which was pretty cool, at least for me. So we'll see if we can get Santa's little house funded. Kennedy wants to know, is there a minimum credit score required with experience, or already owns a property? So no, Kennedy, if you have experience and that can hold you, we can definitely work with you. Depending on how bad credit is, we may need an interest reserve, or maybe you have a credit partner, but definitely reach out to us. That's very usually easy, or something that we can definitely talk through and get over. What is our minimum loan amount? That's another great one. Our minimum loan amount is $75,000. And again, our website does say 100, but we will go down to 75. Pretty much any deal, that can come there with the purchase plus the renovation money, as long as that loan amount is coming out to 75K, we can work on that deal. So someone's asking that he needs the hard money loan for the down payment of a buy and hold. How does that work? Unfortunately, that's not a possibility. You would have, that's called private money or equity, really, is what you're looking for. If you're looking for debt, they call them mezzanine loans, I would look for, or second position notes. Those are going to be really expensive. That's not something that we handle. We deal with only first position notes, which means that, there's no other lender behind us or in front of us. Lonnie wants to know, would it be possible to get a cash out and then turn around and use those funds for hard money lending? Absolutely. That is probably one of my favorite strategies in the market, actually. That is how you go, but that's the BRRRR strategy, right? So I'm buying the property, renovating it, building in my sweat equity, and then renting it out for the cash flow. I'm refinancing it, and even if my cash flow becomes minimal at that point, that's okay, because now I have a deal that's making payments on the principal. So I'm bringing up my equity position in the property every single month. And at the same time, I now took that same money and I'm investing it into a different property, which is going to give me a much higher return anyways, because I'm going to do the exact same thing with it. And I constantly do that and circle it and circle it and circle it and circle it and circle it. That is the best way to go about it. We've seen tremendous results, 2020, 2021, people that were doing the BRRRR strategy. And I think that it's going to be even better now, because now you're going to start to see rents increase. Whereas, again, it may have been hard for people that were doing it over the last year, where now rates jumped up on them, and now that service coverage ratio, let's say, doesn't add up, or things like that. So definitely something to track and learn more about. Can we do a rental 360 in an LLC? Absolutely. Fatima, we only lend to LLCs, right? So all of our products require an LLC. There might be 1 or 2 loan programs in rental 360 that may allow you to do it as an individual. But as a investor myself personally, I would always recommend that you do use an LLC. So Cordell's asking what the amortization is on our short-term loans. There is no amortization, right? When they're interest only, they actually have no amortization. Amortization means that what I'm doing is I'm paying, excuse me, I'm constantly making payments so that my principal balance will come down and get paid off in the 30th year if I have a 30-year amortization, right? If I have a 20-year amortization, my principal payment is going to make me paid in full by 20 years. Because this is interest only, there is no amortization. So what you're doing is you're making those interest payments, and then as soon as you have a buyer for that property, you're coming in and paying us that full principal at that closing from that project. Do we fund in a trust, or do you fund in a single purpose LLC? We do single purpose LLC. Trusts are a little bit tricky. There are definitely times that we have funded in a trust. One way that you could go about it, and I've seen this happen many times, is that you can have a LLC that is owned by the trust. And that's a way to still ensure that you're getting the benefits of the trust, and you're still lendable in the form of from lenders like ourselves. Keep in mind, though, it does have to be an irrevocable trust, not a revocable trust, and things like that. So Ocupado, we do loans for buy and holds. What your question was, and if I understood it wrong, please do correct me. I understood your question as that you wanted to borrow funds for the down payment of the buy and hold. That we do not do. You must have, as the borrower, must have the down payment, and we come up with the debt, right? So what that means is, in the scenario of buy and holds, it's usually, let's say, 80-20. We're coming up with 80% of the purchase price. You're coming in with 20%. We don't lend or have an option for you to borrow funds for that 20%. You have to have that 20%. We're going to give you the 80%. Is it only LLC or S corps? Yes, any type of LLC, any type of corporation will work. And incorporateds are fine too, as long as it's not, in your personal name is really the key item here, right? So speak with your accountant, and they'll help you decide what's the best way to hold your property. Speak with your accountant and your attorney, right? Because they both are going to have different things that they want to keep in mind for you, right? Your accountant wants to keep your taxes as low as possible, and your attorney wants to make sure that you're not getting sued, right? Or if you do get sued, that you have the lowest exposure. So definitely speak with both of them. Make sure that they're both in on that conversation before you decide which direction you're going to go. For interest only loans, yes, we are charging the monthly interest, which means that you're paying that interest payment every single month, and just the interest payment, and then you're only paying the principal when you sell. There is no more interest to be paid, so your principal is the loan amount and the loan amount only. What is the seasoning required for a limited cash out refinance transaction? So I'm assuming you're talking about our mortgage product or a 30-year product, and you're trying to do we don't have limited, we have unlimited cash out. So as long as the deal, as long as your property values at its value, we're going to give up to 75% of that. Whether you owe $1 on it or $1 million on it, that doesn't matter to us. But we have different products, so our seasoning period would range between 3 and 6 months. There's one product, let's say, that has a 12-month, but for the most part, 6 months is probably your average in the market, and we have some products that will allow for lower. Now, you could do what's called a refinance based off of the purchase, your sunken cost, which is like we did with loan to cost, right? Your purchase price plus rehab budget. We can do something like that where it does not require any seasoning. but most people like to wait for the seasoning period in order so that they can take out the extra cash out that's available to them, not just their down payment. No amortization is the payment based like this, loan amount times interest rate divided by the term. Cordell, you hit it on the dot. It sounds like you got that perfectly. You don't have to use the Q&A. I'm looking at both. Just the Q&A was a little bit cleaner. There were definitely a lot of questions that came in the chat box, which I'm moving over to now. I think we finished the Q&A box. So let's see what we got here. How many days from up? Oh, we did that one on the spot. For experienced flippers with good credit, what is the rate? I think we covered that. Minimum credit score required, we covered. So Alex was asking if we lend based on the ARV versus the as is value. We don't use the only time you're using the as is value is on these 30-year products, right? So just for a lot of the new people with us tonight, I know we have a big crowd. I don't want to confuse anybody. Our hard money loans are always going to be based off the after repair value and the purchase price. The as is value is almost irrelevant unless it values for less than you're buying it for, right? So what that means is I can't buy a property, or I can, but I would have to put down more money if they're buying the property for 100,000, but it's only valued as is as 90,000, right? Why would I do that? So granted, why would you do that? If you did and you felt it was necessary, you could put that difference down in cash. But as far as hard money loans, we're never using the as is value. We're using the purchase price and we're using the ARV. Now they both matter, right? I can't exceed one because of this one, and I can't exceed this one because of this one, right? So they both have to be under the threshold that was set by your lender. For those of you asking about the recording, yes, it will absolutely be. I believe it is. Yes, it is recording, and we will share this with anyone who requests. It will be on our website as well. ARLTV is ARV divided by loan amount. That is absolutely correct. So cash on cash return, by the way, for some people were saying that I didn't answer that. The cash on cash return is pretty much my return on investment. So in that scenario where we were looking at the spreadsheet and I made, I think it was $37,000 when I spent $42,000. So call that 92% cash on cash return, right? That 92% is what I made on my cash. That's, I spent 42 to make 38. That is my return on my cash versus saying, oh, I made 37 on the 125 because that's what it costed me. That's what my project purchase price and rehab budget costed me. That's inaccurate, right? That's not a good way to look at your return on your cash. Is it a way to look at your ROI and what that deal did? Sure, yeah, there are reasons why some people calculate that, and there are definitely equations for that, but that's not what we're looking at, right? As an investor, I care about how much money I have and how much money can I make with that. So that's why I find it so important to look at your cash on cash return. And additionally, why it's important to understand that versus the investor who used their own money, because they're now going to come in and spend $133,000 after purchase, rehab, closing costs to make $54,000. Yeah, that's only 37 or 40% cash on cash return. Would you rather make a higher cash on cash return or a lower cash on cash return? Me personally, I like to make higher cash on cash returns. For those asking about the spreadsheet, by the way, like I mentioned, the deal calculator website webpage is what you can use. It has, you'll be able to fill in all those formulas and it'll draft up a nice PDF for you, which you could print out or email to yourself. Appreciate you, Bob, for being there. Thank you for those kind words. For pre-approvals, we could do soft pulls for pre-approvals. Once we're ready to go into underwriting, we will absolutely need a hard pull. Good news though, our hard pulls, being that this is a numbers game and everything that I mentioned about it before, how did this slip my mind? We only are going to run your credit once for an entire year for hard money loans, right? Which means that if you do 20 deals in a 12-month period, you only did one hard pull. And on top of that, we're not even reporting any of this to the credit bureaus, which means that your debt to income ratios are not going to increase because of this. This is solely and completely for the purpose of creating capital, creating profits, and growing your real estate portfolio. Correction of prior question, only there's a charge of 1% loan origination fee. Are you paying anything on the back end? No, there's no exit fees with our loans. There is only the origination fee. Somebody was asking what the track record was. So track record is like your resume, but except instead of you telling me that you went to Cornell and blah 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 schools, you're telling us, hey, these are projects that I've completed and have successfully exited, and that's what we're looking at, and that's what's gonna give some people more favorable terms, right? Hey, I've done this 20 times over versus you who's only done this once. Yeah, that person who's done it 20 times is going to get more favorable terms, right? That's normal. And that's okay, right? We're all here to grow. They were once in your shoes and once had to get the, less favorable terms. More recording request. Can you use more than one property on your 30-year product, such as you have two properties valued at $60,000 a piece, although neither is $75K, but together $120K. Kennedy, I love the way you think. Unfortunately, you cannot, but it does lead me into the ability to say that we could do a portfolio. We could do two properties and include them. However, they would both have to value at a minimum of $100,000 to qualify. So yes, but we cannot mix them. If you did, let's say you were buying those for 60 and you needed 25K in rehab, let's just say, you could kind of make that work, because then you could say you could put down a 10K down payment and you're still at 75,000 loan amount. So that's how maybe you could look at it. But again, the after repair value would have to really make sense there and add up. Would you share any deck for us to review later? Yes, we will share this presentation that we did tonight with everyone that was with us tonight. How is a hard money loan different than a D? Oh, so they're both asset-based. So the question is how is a hard money loan different than a DSCR loan? And for those new investors, you're probably seeing both of these nonstop marketed to you all over the place, and you're probably having the same question that Rashimi's having. So I think it's a good time to help answer this. So a hard money loan is a short-term loan based off the future profits that a deal could make, right? So in the sense of a fix and flip, there is an ability to pay it off. You're paying off the principal. We're looking at your ability to pay off the principal, and that's it, right? We're not looking at your ability to pay off the interest. We're looking at your ability to pay off the principal. And that's by having a deal that will successfully go from beginning to end and make a profit. Now, a DSCR loan, which stands for debt service coverage ratio, right? We're going to explain that in a second, is a long-term debt option, which is going to be based off your property's ability to pay the monthly payment, right? Not based off of its ability to pay the principal, its ability to pay the monthly payment. So debt service, which is pretty much your monthly debt on the property or your annual, however you want to look at it, coverage ratio is the percentage of which your rent is covering your expenses, right? So for example, very simply put, if my principal, interest, taxes, and insurance, which are your four main expenses on a rental property, principal, interest, taxes, insurance, cost me $1,000 every single month, I should be receiving a minimum of $1,200 in rent every single month in order to make sure that I'm covering that ratio. By the way, you guys are asking me such phenomenal questions, but I don't want to go too long. I know you guys all are probably starving and things like that, so I'm going to try to answer a couple more before we finish. But thank you guys. I do appreciate all the questions. They really are helpful in this education process for all of you. But yes, so back to this. So debt service coverage ratio. So those are long-term debts. They're based off your property's ability to pay the monthly payment. And that's really what we're looking at there. Yes, there are other requirements. Keep in mind that DSCR loans are a little bit more, I'm not going to call it institutionalized because it's not, but it's a little bit more box, right? It has to fit the box, whereas hard money, it cannot fit the box. It can be a little bit more make sense. You can be a little bit more creative with it. But when it comes to DSCR loans, they are very box driven. It either fits or it doesn't. You get the rate. It's either, the rate works or the rate doesn't work. But the formula for that is pretty much the income divided by the expenses. And you should get a 1.2 ratio at minimum. That's what most people want. Yes, we do offer 1.0s, negative DSCRs and things like that. But I would not really recommend that to the newbies or anything like that. So if you are experienced and you're looking to do a negative DSCR and you're creating more cash flow through other means, and that's how it makes sense for you, no problem. But I would never recommend a negative DSCR unless you had a very logical explanation to it. What are the requirements for condos? Will you lend if we are purchasing 5 to 7 condos and there is not association? We may want as many units as possible to create a new association or quote or the existing one. You may need funds for the common areas that need attention. So this seems like you're probably dealing, Cordell, with an unwarrantable condo. I'm assuming there's going to be some major underlying issues the way you're presenting it. The answer is yes. However, it sounds like you want to control the association. So I would need a little bit more context on that. We do lend to condos. I'm actually very experienced in the condo space. We've done a lot of condo conversions. We did one actually I was a part of the team that did the condo conversion in Austin, Texas, Zilker on the Park, which was the only apartment building on Zilker Park, which is like think of it like the what do you call it again? What's our park? Central Park of Austin, Texas. But I don't think I really understand where your question's coming from as far as if it doesn't have association now. I apologize. So somebody was asking. Okay, yes, I was just about to answer your question. Yes, Cordell, let's definitely talk offline. Definitely shoot us an email and I will be glad to help you. But Alex asked another really good question, which was, can we help investors use funds from their IRAs or other funds? Now, the answer to that is yes, and it's also no, right? Because why? Because we require what's called a PG on our loans. And to use your funds from an IRA would require it to not be a PG loan, right? It would have to be a non-PG loan. So we do have some options of how we could go about that. Usually it's the way of recuperating those funds, and you would normally have to have the funds up front, and then you would supplement it with the IRA later so that you could reuse those initial funds that you had and keep putting that IRA funds back into more real estate. So there are ways of going about that. It's just not so simple, but definitely reach out to us. Let's have a conversation about that and see if your scenario would be a good fit for us at Express Capital. I do know that we've definitely had some creative ways of going about it and successfully done it in the past. Max, most use hardware because they can't get approved by the bank. Bring back no income, no doc. So we do have no income, no doc. However, I don't like to look at it that way. Because all of our loans, biggest thing you keep in mind, guys, this is not 07 and 08 where banks were approving people left and right and just, lying and straight out doing things that were not right. This is not the case, right? What you're seeing now is we're coming up with more creative ways of underwriting the deal that makes sense for the secondary market, right? Which means that it's not based off your income, because let's just be real, right? Your ability to pay back that loan has nothing to do with your income. You could be making all the money in the world, but if that property's, becoming a money pit, you're just going to want to walk away from it and you're going to have a problem, right? So your income has nothing to do with it. It's mostly about the property's ability to pay for itself. And that's the way that I want you guys to start looking at things. Could this asset afford itself, or is it a liability? And that's going to be really one of the best ways to determine if a deal is a deal for you or if it's something that you should walk away from. Well, I want to just say, while there's no more questions being sent my way, I greatly appreciate every one of you guys for being here. Thank you, Real Estate IQ. You guys have been super awesome to us, allowing us to constantly come out here and educate our future investors in the real estate market. I'm looking forward to working with each and every one of you. And for anyone that has any questions, please just email us. Our email is info@Express Capital Financing. Again, that is info@expresscapitalfinancing.com. My name is Max, and I'm looking forward to hearing from all of you.
Thank you very, very much, Max. It was an amazing webinar. We learned a lot, and I hope everyone has enjoyed it that much. We're just gonna borrow you 5 more minutes, everyone, to show you a little bit of what the demo it's about, so you can feel free to contact us if you're interested in having one of our products. So I'm gonna let you with Brandon from our team to show you a little bit about our demo. Thank you again, Max, and everyone for joining today. It was an amazing webinar.
Thank you so much, Maria. Hi, Max. How are you? That was an incredible webinar, really. I'm just gonna borrow a quick 5 minutes because I'm gonna be showing you real quickly a demonstration for the off-market leads at Real Estate IQ. Without further ado, let me just start sharing my screen so I can start. Let me share here. Just 1 second. Maria, can you confirm that you can see the screen there, please?
Yeah, perfectly.
All right, wonderful. Thank you so much. So Real Estate IQ is a lead generation and solutions company who helps you find deals faster. Basically, your deal is our mission. So we provide the best data, the freshest data for the off-market leads out there. The off-market leads that we have around 7,000 leads per month when it comes to Texas, and we have around 70%, well, our accuracy for the skip tracing information is 70%. We provide more than one contact information per lead. We also have a customized lead mining team who allows us to reach out to leads on any state. So you just have to request that, and we're going to get that information for you. Now, with the off-market leads Real Estate IQ portal, you will be able to customize your search. You will be able to optimize your time and anticipate your deals. How you're going to do this, I'm going to show you just in a second. Before that, I'm just going to show you what are the off-market leads. It is basically a daily list of motivated sellers that you will be able to contact. You can use these off-market leads to improve your lead generation process and start closing deals faster, flipping houses, wholesaling, depending on what you're looking for. With this subscription, you will get the freshest data mined straight from the courthouses. You will get best coverage and first-hand information already clean, organized, and analyzed by our research team. You can see over here that we have our main markets are Texas, Georgia, Florida, and Utah, but we can search leads for any state. What is the difference between the premium and the regular version of the off-market leads? The premium version includes the skip tracing information already, phone numbers and email addresses on it. I'm going to take Texas as an example in this case. In Texas, you can see that we offer subscriptions for metropolitan areas or for the full state subscription, the same way we do it for any state. What type of leads am I talking about? Well, you will be receiving with one singular subscription. You will have access to the pre-foreclosures, appointment of substitute trustee, probate, heirship, evictions, tax sales, delinquent taxes, code violations, loan modifications, and divorce. Now, once I sign up, how will I access these leads? Well, you will have access to our off-market leads portal. If you go over here, you will see that in this part, you have the home page and you have off-market leads. Now, here's all the information that you will be able to look at. Just as I said, you will be able to see any type of lead. We have pre-foreclosures, probate, heirships, tax sales, and all of the ones that I mentioned to you earlier. I'm going to just take pre-foreclosures as an example. With this portal, you will be able to search by criteria. You can search by auction date, date added, date recorded, by ownership of the property, state, city, or county. You will see that your results will pop down here once you do your search, and you can save your searches. You can have those filters in case you just want to go back to any search that you made. You can have this information that appears over here. You see that you can mark your favorite ones. But if we see the details, you have the property address, property city, state, financial information such as estimated equity, equity percentage, and appraised value. But that's not all. If you go into details, you'll get the full information of the property, such as recorded date, auction date, homeowner's first and last name, property address. You will get financial information such as, well, as I said, estimated equity, equity percentage, unpaid balance, loan, appraised or assessed value, And you will also have the loan information of the property, such as origination and expiration year and month. You will see that information over here. And if you have the premium version, it will give you the skid tracing information, which will be this last part you can see over here. You will have phone numbers and email addresses per each lead, and it will let you know if the homeowner is in bankruptcy or if it's deceased. Now, all of this information can be yours. You just have to reach out to us, and we're going to be explaining to you a little bit more about this off-market leads by answering the poll that should be appearing right now on the screen. We will going to reach out to you. So thank you so much for your attention, and Maria, back to you.
Thank you very much, Brandon. Thank you, everyone, for joining us today. I hope you enjoyed it. Thank you, Max, once again. And I hope you enjoyed it, and you can join us in future webinars. If no one else has any more questions for Max, we're going to finish this webinar, and I hope you all have a great evening and a great week. Thank you very much. Have a wonderful day.